So, I'm Ricardo. I work with Trojinn, and I do real estate investment. By the way, feel free to come on in if you want to hear better. I started Trojinn about 4 months ago, and I did it as a result of my personal experience with real estate investing. I have a blend of accounting background, data science background, and a few other things that give me kind of a unique edge on real estate investments. So, first off, how many of you think real estate investing is easy? How many of you think real estate investment is easy? Anyone got a... Okay, so apparently no one thinks it's easy. It's about right. How many have actually purchased property before? You? Okay. And how many want to purchase something that haven't? You all are married or... Okay. So you all gone through the whole process, you know what's going on. Cool. So I'm going to be probably rehashing some things that you all have discovered since you all seem experienced, but let me know if you discover anything in the process of listening to me that you want to highlight. I want to be interactive, so if you have questions, blurt it out.
I bought a house, but not an investment property.
Well, that's a thing, because I believe every house purchase should be viewed as an investment through the lens of that. But then you can color it with your emotions. Like, I really like this place. I'm willing to take a hit on the pricing for some reason or the investment quality because it's personal to me. But you should still evaluate it. And that's kind of what I'm going to be bringing into this talk. So I'll be talking about what are the common misconceptions in real estate investments, the principles that really you should anchor your decisions by. So principles you should really be thinking about as you're investing. Lastly, what you need to succeed, Trojinn, the mission, the tools, and my personal journey in real estate investment that will hopefully enlighten you a little bit and make you a better investor, home buyer, home seller, or realtor if you're one. So first, one of the misconceptions is that real estate is a terrible investment. My uncle was telling me growing up, don't ever buy real estate. It's a money drain, and you're going to be really regretful if you get like apartments for rent, for example. It's a tool. And like any tool, if you use it wrong, you're going to suffer the consequences. If you use it correctly, you can reap the benefits. And that bias towards saying real estate investment is a bad idea makes you overlook great opportunities. Second, it's impossible to get a deal in a hot market because everyone thinks that by default, everything's going to be bid up, everything's getting looked at. But the truth is that emotions blind people from finding good opportunities in any situation. And the busyness of the market sometimes can cause people to make errors. And you can always find a deal. The key is, are you patient? Do you have the right information? And can you make a decision quickly? So people will not think that they can get a good deal. And then they'll start just giving up on trying to find something and overpay on property and rush their purchase. Then there's, best practices on negotiations, like, is it okay to offer below list price? Well, if it's listed too high, yeah. I mean, you might get a slap in the face, but it's better than going into severe debt because you overpaid. So, personal story, there was a place in Bellevue I was looking at about a year ago. They had listed it pretty high and obviously didn't get attention. I offered them about 15% below list price because that's why I evaluated its worth to be given the condition of the place and the comparables. They said, no counteroffer, we don't want to speak to you, go away. And then 2 weeks later, they called me back saying, is that offer still good? And the reason why is because they finally acknowledged that their situation was not as rosy as they thought it was. And at that point, I already had been looking at another property, but I could have entered at the price I wanted because I was patient and because I didn't let my emotions get the best of me. A lot of times you have to really take a handle of your emotions and then just be very patient with people's emotional state when you're talking to them. There's also the idea that being successful is easy and any purchase is good. That's also really bad advice because some people will just say, no, I just need to get into the Seattle housing market. It's booming. I'm just going to make a ton of money, kind of like Bitcoin. I just put money in Bitcoin and suddenly I'm rolling around in money. It's not that easy, and if you don't scrutinize your decisions, you're going to suffer. Also, money is the only requirement is a terrible idea. It's not just about money. You have to have expertise and knowledge on what you're doing to succeed. But money is a requirement to get a place. You can't just, get something without the funds. You have to find a way to get funding. My realtor is an expert, and he or she says everything right, and I should trust everything they say. That's really dangerous because a lot of realtors, like a lot of people in any industry, regardless of what their profession is, are not good. I'd say 80% of engineers are not very capable. 80% of realtors, the same thing. It takes that really exceptional, passionate person to become good at what they're doing, regardless of the industry. And a realtor is no different. And in fact, a realtor has a fairly complicated job if you actually take a step back and think about it, because they have to be a counselor, they have to be your financial advisor, they have to be legal advice, they have to help you negotiate, they have to do all these things, and the training isn't necessarily there to support that. So always, unless you've worked with a realtor for a long time, scrutinize their opinions and make sure that you don't take everything for granted. And lastly, I can do it all on my own. That's especially dangerous when it comes to home remodeling. If you ever watch the HGTVs and everyone's like, no, I'm just going to remodel my thing by myself and I'm going to start making a ton of money, save money. That's dangerous because costly mistakes happen when you don't know what you're doing, and YouTube videos are not always the best, and Home Depot contractors might not be telling you the right way to do something. So always get opinions and then ask for help when necessary. So, principles to invest by, keep these in mind when you're doing your stuff. Succeeding consistently is only done through getting information that people don't have, or being willing to do people's jobs that people aren't willing to do. If you don't have one of these two, you're not going to be succeeding consistently. Patience is a virtue, stubbornness is a flaw. So patience would be, let's say, me putting an offer and then getting a lot of rejections because it's a little bit too low. Stubbornness is, no, my house is really worth as much as I think it is. And then you start penalizing yourself because it's becoming a stale listing and no one's really bidding on it. And suddenly you're just not acknowledging the situation. Another one that's important is low risk can have high reward. High risk can have low reward. So a good example is banking. Right now, the Federal Reserve gives money to banks at 0.25% interest. And then they lend that to you for about 4 to 5%. So that's free money. Super low risk, but high reward. Same thing with high risk, low reward. If I put all my money into Bitcoin right now, I might get really penalized. You always have to think about the reality that information influences your risk reward. And lastly, set goals and don't get greedy. If you set your goal, pull out when you think it's good, enter when you think it's good. Don't get greedy. Don't get blinded by the money. Now, regarding some of the skills you need to succeed, I went to a Fortune Builders Bootcamp. I'm not sure if any of you have heard of Fortune Builders, but I went to them about a month ago to kind of see their methodology. They charge about $200 for a 3-day workshop. I'm trying to cram everything into an hour to give you an overview. But then they charge about $40,000 to $50,000 for the training process afterward to learn all the skills you need to succeed. And it's because there's a lot that's required. You have to be able to do accounting and financial analysis. You have to know tax law to best capitalize on your investment. You have to have legal knowledge to write good contracts, have good negotiations. You have to be able to negotiate with contractors on a personal level, make sure that they're not overbidding, underbidding. You have to make sure that you understand the remodel process if you're going to be doing remodeling, or the management process for properties. For example, being a part of a renter association so that you can go ahead and screen tenants properly. Then there's patience and planning. And lastly, you have to have the funds. That one, there are many ways to acquire funding, some better than the others, but fundamentally, this is a skill set that you need to acquire to have a pretty good shot at succeeding consistently. So I'm going to touch upon my personal journey. So I bought my first place in October. By coincidence, I ran the numbers. It looked good. And I said, hey, I should remodel this because it seems like a great idea. And I decided to do most of it myself to learn the process. I still hired contractors for things like plumbing and electrical that were required by the city. But I learned through the course of like 800 hours how you do good tiling, how you do good flooring, how you do painting, how you install cabinets, stage the whole process. And it was an expensive lesson, but because of that process, I really learned what it takes to do a good job of flipping a house, which allowed me to, in my third property, essentially remodel it using my cell phone over the course of 50 to 100 hours without really trying, at about half the price for the same scope of work. So there's a lot to be gained by knowing what you're doing. And one thing I realized through this process is a lot of my friends wanted to learn how to do this themselves. So I have a condo like several blocks from here in downtown Bellevue, small HOA, 7 units. And after I purchased mine there, 3 of my friends purchased units next to mine because it was such a good deal. And they essentially copied what I was doing. But through the process, I was guiding them, like, this is what you should buy. This is how you should approach the negotiations. This is the right price point. These are the good contractors to work with. And it smoothed their experience a whole lot from the troubles I was facing because I didn't have that mentorship and guidance. And once I started going through this process, I realized that there was this need to advise people on, is remodeling worth it? If so, what's the scope of remodel that's worth it? What's the process? How do I evaluate the house? What should it rent for is a good example. How can I keep spotting good deals? So I realized I was good at finding deals and evaluating them. And that's what kept my friends coming back to me for guidance. And so all these things that I built for myself and all these skills I acquired through my experience, I realized I can go ahead and turn into a service that will inform and empower people. And the one thing I really want to highlight here is you don't have to keep dumping a ton of money to buy real estate and have good return on investment. You can leverage your existing real estate intelligently if you appreciate it properly. So for example, I had my initial investment in my first place, and that appreciated so much, and because I got such a good deal, it financed 2 other purchases. And at the same time, I'm able to keep my cash flow at basically the cost of renting a room in downtown Bellevue. So if you do things right, you can really do well. If you do things wrong, you can be essentially chained to a mortgage for 30 years. So the key is how you evaluate the deals, how you negotiate, how you empower yourself with the right information and tools to make the most of your investment process. I've been going through fairly quickly. Does anyone have any questions on anything so far? Okay.
I had a quick question.
Yeah?
How do you calculate the ROI?
Cash invested versus equity. So, for example, let's say I buy a house at $500,000 and I've put 50 grand in because 10% down payment. Let's say that thing is worth now 600. I have gained 100K because I owe 450 on it, and so my ROI is going to be the appreciation over cash invested. Now, you have to take into account, your interest costs. You have to take into account like whether or not you remodeled. That's more cash being put in. But for the most part, it's just your funds put in versus your equity. And one of the things that really makes sense in Seattle is flipping. So if you're trying to get into investments in Seattle for rental income, that's really not reasonable if you're doing it with large-scale apartments, with small-scale apartments, because the cash flow is not there. So in Seattle, it's much more profitable to flip than it is to buy and rent. Me, the way I analyzed it was I buy a place, I acquire it, and I get the rental income to hold on to it while it appreciates. So it's essentially an investment that's growing at a significant rate, and it takes care of itself. But if I was, let's say, in Texas, I wouldn't be counting on my appreciation to increase the investment value because no one wants to live in my hometown. It's basically flatlined real estate prices for the past 20 years. And it's going to continue that way unless you're in the right spot in town. But the problem with Texas is there's a lot of land, so a lot of times if someone doesn't want to pay for your premium land, they just build next door because there's an empty lot. Whereas in Seattle, there's scarcity in land. And so there's a significant appreciation in housing prices. And that's where your investment really begins to generate ROI. Not so much the cash flow. And so it's important to really view your investment from the correct lens. Is this a cash flow investment or is this an appreciation equity investment? And then you want to balance these things out because you never know where your situation is going to be. Maybe you get laid off. Maybe you have kids come out of nowhere. Maybe you get injured. It's important to make sure that your investments are something that take care of themselves well enough to where you don't ever become desperate and have to sell. Because when you become desperate, that's when you lose. It's the same thing with negotiation. If someone knows that I really want that house, they can stick firm on their overpriced value. But if they know that I'm kind of apathetic on it, they might have to come down a bit if they're starting to become impatient with their selling process.
How are you calculating appreciation and then factoring in where we could be in the southern bubble, pricing, stock market, everything drop?
See, that's a really good point. And that's kind of why I was talking about being careful with your investment, making sure that you can handle it given change in circumstances. So one of the things that this actually touches upon a few different things, but I look at comparables as most recent. So I can't predict the future, and I like to be conservative with my estimates. And so if a house sold, or if a house is valued based upon comparables and some algorithm that I can talk about later in detail at $500,000, I'm going to try to buy it at $400,000 because I want to be careful and be able to take that 20% dip if the market turns around. But you have to also be patient because things go up and down. So I would say that if we are in a bubble in Seattle, how bad can it get? Do you believe in Seattle long term, for example? And do you think it's going to be more valuable, significantly more valuable in the future? I view Seattle kind of from this heuristic, which is Seattle's getting influenced by foreign investors from China, for example, from Silicon Valley migrants, from Vancouver migrants, because the real estate here is not as expensive as there. The job and industry here is similar and really, really good. Environmentally, Seattle's fantastic. It's got great quality of life. And so I view that Seattle's plateau, if it does hit a bubble, as the price in Silicon Valley or Vancouver before it starts to essentially spill over to other places. But it's difficult to say the appreciation is going to stay there until you've sold it. And so you can kind of lock in that appreciation using lines of credit. So for example, I have a place that I used to finance my third and fourth purchase, but I didn't sell it. I got a line of credit against it, and that line of credit was used to purchase other property. So it's as if I sold it, as if I acquired that appreciation without actually selling my property. So you can hedge against a downturn by using credit lines, and you're betting that 10 years from now, the US is still a country. So there's always risk. But you can kind of mitigate that risk and appreciation by taking equity out right away in the form of line of credit. So going back to bullet point number 1, my process is find an area you believe in. If you don't believe in it, why get something that's going to be stuck there because you can't move that house? Seattle I believe in because the industry here is infrastructure technology. It's not Snapchat, it's not Instagram. Well, Facebook technically counts, but it's things that if they go away, if Amazon goes away, if Google goes away, we have bigger problems than whether or not you can pay that mortgage, because those are utility-style technology companies, whereas other areas might have more unstable industries. You might have to take more of a gamble that the economy is going to be good in the long term, because maybe some of those startups in Silicon Valley aren't worth what they think they are. And maybe they won't be around in a few years. So Seattle, I think, is a fantastic bet for a long-term perspective. And I'm sure there are other places in the US that are fantastic bets too, but you have to find them. So find an area you believe in is number one. Number two, find listings in the area that have room to appreciate. So earlier I said that you have to have information people don't have, or be willing to do things that people are not willing to do. That's the appreciation aspect. If I can buy something at a discount from what I believe its value to be, and then add value to it through home improvements, for example, or tearing it down and constructing units on that piece of property, that's where your appreciation comes in. And the reason why real estate can be very good or very bad for investments is because there's a lot of gray area on what something's worth. It's very difficult sometimes to evaluate the value of a piece of property. But that gray area is where you can capitalize. It can also be your downfall if you don't do things properly. Then, once I've found the listings for an area, I look at the financial analysis for every property. So over here, I'm explaining essentially the difficulty of the process steps. So it's easy for me to find an area I believe in. It's just kind of getting a finger to the wind feel of the place. Is it going to be someplace I want to live in 10 or 15 years? Second, evaluating everything in an area is a very expensive, timely process. But it's essential if you want to be confident that you've made a good decision. So once you've gone through every listing in an area, and you've got an estimate of which ones can appreciate, and you've run financial analysis to get an idea of which ones have good ROI based upon the expected cash flow from rentals, based upon your appreciation if you do remodel it, based upon your maintenance costs, your acquisition costs, then you can kind of stack rank which ones have the most likely are most likely to be good return on investment, and start identifying the purchase price you want to acquire at. And then sanity checking the good candidates, because sometimes something can have really good ROI, but in reality, it's got foundation issues, which you didn't factor in your estimates. So you essentially go through and sanity check all the potential candidates from best to worst.
How many deals or properties are you evaluating, or you actually decide first?
I personally evaluated everything on MLS in an area because I wrote software to do it. So that's how I built Trojinn. I built it for myself because I got tired of actually walking through Zillow and Redfin by hand and trying to figure out which ones were the best deals. But there's no rule. It's just when you're confident that I've done my due diligence and this thing seems like a really good deal. I'll give you a personal example. There was a place in Queen Anne that I purchased recently where the listing was being done badly. Like, I look for bad listings and bad realtors because that's a sign of a good deal and good negotiation potential. And I knew this was a bad listing because the specifications on the listing were inconsistent between different listings. It was listed for sale on one website and not the other website. And it had been on the market for a long period of time, and the photos were terrible. But the numbers were really, really good. So I checked it out. Numbers made a lot of sense. And I estimate I got a discount on that of about 20% in the summertime in Seattle. But you have to be able to evaluate everything that exists to really pinpoint those, because my estimate is about 1% of things are really good deals. 5% of them are pretty good deals, meaning like 5% discounted, and then the rest of them are pretty much at value or above value. There are quite a few that are significantly above their value and people are overpaying, but that's because of the market. But there's always going to be someone screwing up, and you have to find that. Any other questions? Cool. So Earlier I touched upon the importance of being able to identify good deals, but there's also the need to act on them quickly, because once someone realizes it's a good deal, you're competing. And if you're competing, you're losing, because when two people want something, you can't win. That's really where a lot of the pain point comes in, is identifying things that are desirable that no one's realized is desirable yet. Either because they're not willing to put the work into it, or because it's not obvious that it's as good as it should be. And so putting aggressive offers in to seal the deal is very important. You have to be quick. Which is where the whole research process helps build that confidence, so you can do that quick decision. Because in the end of the day, if you made a bad decision, you can always sell it. You're not married to it. But it's more painful if you have to sell at a significant loss than you have to sell at what you purchased at. Because at that point, it's just transactional costs. You can also research the owners, understand their situation. That's actually quite important, because sometimes you can be more sensitive to their situation. I've personally found good deals because I understood someone was unhappy with managing their rental. And I said, hey, you're not happy with it. I'll take it off your hands for this price. I think it's a fair price. And they don't want to go through the trouble of getting a realtor, listing the thing, having people visit it, getting the renters to leave. They want to get rid of it. It's a strong signal, and you're helping them stop thinking about a burden. Because in their mind, it's not an asset, it's a liability, it's an annoyance. But for you, it could be a good deal, something that you're willing to take advantage of. And so understanding the person's context through either knowing them personally or through county records, because you can find if someone, for example, is trying to liquidate their assets, can give you negotiation advantages by changing the closing dates, by changing the offer to more earnest money, contingencies being waived, and so forth. If it's an older lady, maybe she doesn't want to fix it up for you. Maybe she just wants to sell it and walk away. So that's the personal touch you can't really automate, but you can research it pretty easily. Being patient's important. Like I have to stress this over and over again. If you're not patient, you're going to lose. And if you don't get the deal that you put a bid on, so be it. You didn't want to overpay, and you felt that that was a fair price. And this is a very nice thing that a lot of people don't realize they should do, is get remodel estimates and possibly contracts in place before closing, because that will give you a more certain idea of what it's going to take to flip it if you're trying to flip, or if you're trying to just improve it before you rent it. Because my models are pretty good at estimating what something should cost, but sometimes you have nuanced contexts that really jack up the prices or the timelines. So for example, you might have foundation issues, and foundation issues can be a challenge because you have to go to the permit office to get approval to possibly support the foundation, and that might take 4 to 5 months because the city is really backlogged with construction, which that's something you have to deal with, and you have to know going into it that that's a cost you have to factor in. So while you're closing, while you're doing your inspection, get remodel estimates, because if worst comes to worst, you can always pull out with no cost. Inspection clauses are really nice for that. They'll let you just say, I'm going to back out because this is not working out the way I expected it to. Any questions?
So what do you think of the bureaucracy here in Bellevue? Is it complicated? Is it difficult to work with? And then second, contractors, construction right now is in high demand. Mm-hmm. And are you also getting a good deal on the real estate, but you're paying a premium on the remodeling because of the high demand? For sure. That can totally happen. So the bureaucracy, I would say, is unpleasant but essential. So I'm going to give you a personal example. My hometown, you can have shacks next to really nice high-end buildings because there's no real zoning. So your big fancy investment can get sunk because someone's being a stubborn person and they don't want to sell, they don't want to
accommodate the neighborhood's look. Seattle's trying to control everything, which it takes time and it's difficult. And they're trying to make sure that the infrastructure will be done well long term. I'm not going to be able to say if they're succeeding because I'm not well enough aware. But what I can say is I think the effort's essential because people will cut corners. I know that there was a buddy of mine who had a contractor who didn't use concrete backing board for his shower. So a year after his brand new house was built, he's got mold behind his tile in his bathroom because it's not done properly. And that's something you can't see right off the bat, which would only get caught by having the city people check it out and then force the inspection to sign off on it. Now, regarding the pricing, that's why negotiation is very important. That's a skill set that you have to develop. So I have done my remodels for approximately $30 to $40 per square foot complete overhaul. So I shoot for that when it's brand new cabinets, flooring, tiling, painting, new lights, granite countertops. But you can easily pay $80 or $90 or $100 a square foot because you didn't negotiate well. I remember there was a contractor who was giving me a quote for the kitchen work. He was like, "Oh, your kitchen, 20 grand." And this guy was very busy. He had his Bluetooth headset on. He was very tall, very sure of himself. He thought I was an idiot. And so he doesn't even bother asking me about my context before he tosses out that bid because he thinks that I'm going to just say yes to whatever he gives. But in reality, that project should cost 6 to 8 grand. If you're not requiring that person, like if you need a specific contractor, you're sunk because he can dictate the price because he's necessary. But there's always more contractors if you're not in a hurry. So the 4 dimensions I use to evaluate things are timeliness, price, quality, and manageability. Is your contractor hard to manage? Is their work good? Do they do things on time? And what's their price? I'm willing to forego manageability and timeliness for pricing and quality. So you have to find people that have well-defined contracts and will honor their contracts so you can hold them accountable. So if you have a bid and then the bid's in writing and says, we will do this work on this scope for this price, you make sure not to pay them until they've done it to a satisfactory quality. And you can always have that leverage against them because they don't have the ability to force you to pay them if they haven't honored their contract. So you can protect yourself from greedy contractors and bad contractors through contracts. But you have to negotiate well, you have to get multiple bids, and you have to define contracts really, really well. And you also have to account for suppliers. Like if you're getting cabinets from a place, you have to factor in the delivery time, setup time. So there's a lot of these nuances that get overlooked that I have experience with and I advise people on, saying, hey, when you're doing a remodel, make sure to expect this much time, make sure to stage it this way, make sure that this person does their work before that person, because you want painting done after demolition, but before everything else. You don't want painting done while carpet's there because it's a lot harder. It takes more time. You have to set up things more. So there's a lot of details that go into your question, and I hope I answered all of them. Okay.
So piggybacking off of this question in regards to contractors being weeks out at the moment to get something together.
Mm-hmm.
Now, as you mentioned, getting obviously estimates with inspection contingency.
Yep.
Now, how realistic is an inspection contingency in a market where you're getting 5-10 offers in a month? Inspection contingencies are one of the first things that go out the window.
Mm-hmm.
The way I see it is that an inspection contingency to have that in there,
Yep.
you're going to already be paying a premium up front.
Yep.
So you're going to be paying 5-10 grand extra because the seller will take a clean offer, no contingencies, for $10,000 less than, say, someone that has an inspection contingency. So already there, you're in 10,000, 5,000
Yeah.
more.
Yep.
And for what time of inspection contingency?
Yeah. First, if you're competing against 5 to 10 offers on a house, you're already going to lose. So that's not a situation where you're going to get a good investment unless it's something where you can do something exceptional with it, like tear down the building and then subdivide the lot several different ways. At that point, paying a premium might be acceptable. I do know that sometimes it's difficult to get contingencies to work given the time constraints, but most of the time there is a way to make it happen. And if there isn't, you can use a best estimate. So for me, I have my rule of thumb on what it should cost, and I use that as a guideline going into negotiations. If I don't have a contractor available in time to get that estimate kind of in writing, I'll estimate how confident I am that my estimate on the remodel cost is correct. But you have to be able to depend upon yourself or someone else who's a knowledgeable expert to establish that remodel estimate cost. Contingencies do hurt you in this market when you're competing against a bunch of offers, no doubt. And that's why I stressed before, don't compete if you can. Most of the time you're going to lose if you're competing, especially if everyone's bidding up a place. So a lot of times if you see a home on Redfin and it says hot home, you're not going to get a good deal. You're going to lose. But if you really like the location, if you really like that place because it fits some emotional connection for you, acknowledge what you're paying above its value and then be happy with that. Because sometimes it's not about the investment. Sometimes it's about getting something that's personal to you, that fits your needs. But you should at least evaluate how much you're overpaying for yourself. Any other questions? Cool. So one thing I want to touch upon is the reality of real estate. Most home buyers don't realize that they're in over their heads when they're going through the process because it's not a skill set that you learn in school. In fact, a lot of skills that are super important for life, you don't learn in school. A lot of our education system doesn't enable you to succeed as an adult because it doesn't teach you financial savviness, for example. But that skill set's essential for making your decisions on where to go to school, what degree to get, where to live, what to do with your finances. And the same thing happens with home purchasing. A lot of home buyers think that, oh, I get a realtor, they handle all the complexity for me, they act as my guidance for all my decisions, and I just give them money. But the most important financial decision of their life, a lot of times, is going in with the least amount of preparation and support, which is, unfortunately, most people. So hopefully, most people don't get screwed over, but most people will unknowingly get into a rough situation at some point when they're purchasing if they haven't done their homework or acquired the skill sets necessary to succeed. One of the other challenges is right now each party's motivations are disconnected from each other. Your home buyer, home seller wants to get the most profit possible. Your realtor wants to get the transaction to close at a high price. Your contractor wants to just get a bid and start working, regardless of whether or not the work is actually necessary, because they get paid off of work done, not work required. And so you have to be aware of everyone's motivations when you're working with each party. Don't be upset at them for that, but realize that their intentions might not be aligned with yours. And lastly, being a realtor is difficult. I know that I keep harping on realtors, but I think that it's a very complicated job, and it's not requiring the amount of training and preparation requisite for that position. You can get a realtor's license fairly quickly, but to be a great realtor, you have to have a ton of different skills. Each of them would be a job in itself. So a few realtors that are exceptional, hats off to them. Most of them are not. So now that we've gone through all the challenges and complexities, that's kind of where I built Trojinn. Trojinn it was a tool set that I built for myself to find deals. I evaluated everything in an area and say, these are most likely to be the best return on investment. But I realized that that's something that could empower a lot of other people because I don't like disinformation. I personally don't like it when people are punished for their ignorance, despite trying to learn something, or because someone was confident and misinformed them. And so my goal with Trojinn is to help people get quick information and guidance to make a decision intelligently, essentially protecting you from bad decisions. Whether or not you understand the value of a property, whether or not you understand the cost of remodeling, whether or not you know what you should list your property at. Because a lot of times if you overlist and no one bids after a month, your property looks black marked and suddenly you sell for a lot less than it should have sold for. And a lot of these decision-making processes are handled by gut instinct right now, which is not good. But you can add some rigor to it by looking at the data, looking at statistics, establishing some models, and say, this place should remodel for this much, should appreciate this much when it remodels, I should buy it for this price. And that's where I've essentially automated a lot of the decision-making process with my toolkit. And so if any of you go to my website, you can play with the demo, you put an address in, and it'll give you a full-blown CMA saying, this thing is worth this much because these comparables are here, and the photos make it look like it's remodeled. So it helps you quickly get a bird's eye view of, is this worth looking into further? Or if you want to have an idea of what the remodel cost should be for a place, you can reach out to me. If you want to know if you should negotiate a certain way, you can reach out to me. Basically, if you're trying to buy real estate, fix it, empower yourself with some of the stuff I've built. It's going to save you a lot of time, a lot of headache, and it's stuff that I've learned over many, many hours. And that covers all the stuff I wanted to speak about. But if any of you has questions, please let me know. So you had questions, anyone? Yeah?
So this Trojinn, is it online?
Yeah.
Okay.
Spell like that, so Trojinn.com. My demo page is showing you my image grader. So essentially, I've built something that looks at photos the way you do. So it'll be able to take the property photos and say, hey, this is remodeled. This is a lot like this other property next door that was remodeled. So if you're looking at, let's say, Redfin or Zillow, their estimates don't take into account context as well because they're taking the database information put in by realtors. They're not looking at the images. And so sometimes if you have two condos in the same unit, the remodeled one will score worse than the out-of-date one simply because they don't look at the imagery. They don't update their estimates. Obviously, that can lead to a lot of variance in the estimates, but it does a pretty good job in most situations. And that's one of the things that's actually fairly problematic is appraisals are very much a personal approach. So for example, when I was getting my line of credit on my first condo, I had an appraiser come to my place on my third one. He came to my place and he appraised it way below what it should be. And I know it's below what it should be because my other unit is 25% smaller and it unremodeled appraised at 450. The remodeled one that's 25% bigger, the appraiser said 500. And it's because there isn't a standardized process right now for evaluating the value of a house. And one of the problems with a lot of these online estimates is they also don't explain how they come up with that estimate. And so a lot of times it won't make much sense and you'll be like, this number doesn't really agree with me, but I can't tell why it's wrong. In my estimates, it's very simple. I show you the comparables, I say these are the most similar ones, therefore this is the price. Because at the very least, if I'm wrong, you understand why. It's not supposed to be 100% accurate, it's supposed to be accurate most of the time, but explainable all of the time. And that's one of the things that's actually a big trend in data science this past year is the importance of explainability in your numbers. So if I'm a lawyer, for example, I don't want to go to court and have AI tell my client that he's going to jail, but not be able to explain its decision-making process. So a lot of these artificial intelligence products are starting to forego a bit more sophistication in their models and the complexity of their decision-making for improved scores and backpedaling to say, we're going to take this hit on performance for the sake of explainability. We want to make sure that people understand why we're recommending what we do. And that's something that I think is really important. So I built my stuff to align with that principle.
estimation of remodeling that your Trojinn is?
I haven't evaluated that yet because I have my personal small set of numbers, but I'm going to be essentially acquiring data. And once I've done that, I'll be able to do that report after the fact. But my experience on the past 10 or 12 estimates is I'm within 20%, which 40K to 45K is a pretty small gap, especially compared to the real estate prices up here.
So all the base data you got, are they based on the setting of the same condo in the same
Yeah.
area?
So if you want to remodel a place, I can tell you if it's worth remodeling, and if so, how much should you remodel it, and what you should expect in terms of appreciation. Because a lot of times if you're in a bad area, it doesn't make sense for you to remodel because you're going to have no one that wants to pay for that premium. And sometimes you can over remodel in a decent place by doing too much. So you have to really tailor it to be as good as the nice stuff, but not better.
So I was going to say, I just came up with this. The same thing. There's an outfit called RS Means that puts out all this data, and it's really expensive. And I was just like, oh, this sucks, you know. But come to find out, it's in the library, and it's free. So it's called RS Means, and it's a book about this big, and it's by city, and it just has all that, how much your mileage.
Yep. There are a lot of statistics out there, and you can apply those statistics to your estimates, and that's essentially how I would do it. If I wasn't doing it in Seattle. In Seattle, I have personal knowledge, but in another area, I would essentially take statistics for the area and connect it with the scope of the remodel.
Do you have markets identified within the Seattle area, like 7 years, 6 months in market? Which one is hotter?
I view it kind of as a few epicenters, and the things are expanding outwards. So for Seattle, you look at like Seattle downtown central district area, and then it spreads out. And right now, it's kind of hitting North Seattle to Judkins, South Seattle area. Now starting to get closer to the airport in terms of appreciation. That's where the swing up is really accelerating. In Bellevue, it's still Bellevue downtown, but spreading out closer to the Renton area. So you do have these already saturated price points, and then you have these points where they're accelerating, but that's more, I haven't done a report on that yet. That's what I've been seeing from my analysis. So I'm going to be essentially conducting a bunch of studies now that I've got my models up and running and people are starting to play with them to essentially show how my image grader will correlate strongly with price per square foot, how I can predict the next place to accelerate in terms of pricing, but it requires a lot of data, a lot of rigor, and I want to make sure that before I have confidence in what I'm saying, I've done the study.
How long have you been working with this data?
I've been setting this up for the past 4 months, but my tools are about a year old, and so I've been refining them and getting them into production so people can essentially play with them outside.
How do you compare your model to, so if you have knowledge in Seattle and it's, how do you make sure that you're not biasing the model in Seattle compared to others?
Yeah, because right now I'm using South Texas as well, which is a totally opposite market. My cousin's a realtor there, so I got access to his MLS database, and I've been looking at modeling that area as well. There are some very simple mathematical concepts that work really well when you apply them properly. So for example, for forecasting, you can just go ahead and look at sales data and see the change in sales data over time to get a decent estimate of appreciation. But you have to factor in the quality of the properties as well. So the trick isn't not necessarily the mathematical equation, it's in curating the data so that your model is looking at the right stuff. If I give garbage to my model for the image classification, it's going to give me garbage back. So a lot of the work is coming into data curation, making sure that my data going into my fairly simple models or my complex models is sound. Yeah.
How is it reliable to some? So if you compare two pictures, one is on a...
If you give me a picture, I tell you on a scale of 1 to 5 what the quality of the place is.
Well, and that's not sensitive to lighting. That's not sensitive
It is, but it's not super sensitive. It looks for concepts like modern design, looks like concepts for like, is this place out of date? Is there color mismatching in certain areas? So it's been trained on tens of thousands of photos from different listings, looking at dilapidated housing, looking at remodeled housing, looking at different architectures. And it does a pretty decent job of identifying which ones are nice and which ones are bad. But it's still improving because I haven't added architectures from other areas. So as I add more data, it'll get better. But right now it's good enough to tease apart which things are better than others, which things are worse than others in the same area. So it can kind of stack rank the quality of the comparables. Mm-hmm. You just gotta get the pictures. Any other questions? Well, thank you all for coming. If you all want, take my business card, go to my website, play with my demo, try to break my stuff. I want to make it better. So give me feedback if you disagree with stuff. It's still getting beta tested. I have realtors hitting it. I'm personally using it, obviously. And if you all can play with it and give me feedback, it'll make it even better. And thank you all.